Back with the street signs on a Wednesday. Take a look. Asia's pretty clearly risk off so far today ahead of the UK polls, James Comey's testimony, of course, also the ECB meeting. Money coming out of Wall Street overnight, as you can see. I want to show you something else here. Take a look. Equities are still near record highs. Yes, that's true. But the 10-year, though, is back near 210 now, where we were before Trump won the White House. So raises the question, who's right? The stock market or the bond market? Let's bring in Peter Schiff right now, CEO, Euro Pacific Capital, joining us live out of Toronto. Peter, good to have you listen. Good to see you again. It's been a while. What is the short answer to that? Stocks or bonds? Who's right?
Well, first of all, I don't think the stock market necessarily reflects what's happening in the economy. I mean, you could just as easily make an argument that the stock market likes a weaker economy because the weaker economy keeps the Fed in play. It keeps interest rates lower. And in fact, I think the Fed is getting ready to reverse course, and we're going to get rate cuts and another round of quantitative easing. I think the bond market is already sensing that. I think the weakness or the strength rather, of the bond market, meaning the lowering of long-term yields, is a reflection of reduced optimism on the part of traders about the U.S. economy. But, you know, where the bond investors may have it wrong is a weak economy is not necessarily good for bonds, because if the Fed has to stimulate a weak economy by printing more money and creating more inflation, that is bearish for bonds. When money is losing value, if you're a lender and you're going to be paid back in depreciated currency, that is not a positive thing for the owner of that bond.
Yeah, indeed, and therefore, I mean, the corollary to that is basically, is it going to put pressure on the U.S. dollar? It's going to be bearish dollar, is it not?
Well, I've been bearish the dollar for a while, and we did have a big rally in the dollar that really ended when the Fed started hiking rates. But I think that dollar rally was a bubble, and the air is only beginning to come out of it. You know, the dollar hit a 6-month low today, but it still has a lot of ground to surrender from that rally. The rally was based on a misunderstanding of the true strength of the U.S. economy and the efficacy of Fed policy. I think people were betting on the dollar made a wrong bet, and they're going to find out over the next several years just how wrong those bets were, because I think the dollar is headed for new all-time record lows, and the converse of that is gold.
Okay.
Gold is going for new highs. Gold hit a new high for the year today, but this rally is just getting started.
Okay, so pin some numbers on that. If you're talking about record lows for the dollar, say DXY, how weak are we going to get there? And conversely, gold, how high is that going to go?
Well, you know, the last time the dollar made a record low was around the summer of 2008, and the dollar index was close to 70. I think this time my minimum target for the dollar index would be 60. But I do believe that ultimately we're going to go lower than that. And I think we're going to have a dollar crisis. And I think ultimately it's going to force the Fed to do what it's long resisted doing, and that will be to aggressively raise interest rates in the face of a recession and really bring about a much more severe financial crisis than the one we had in 2008.
Ouch. Sounds pretty bearish to me. So here's the thing, Peter. I know you're long EM markets, and I assume that would include EM Asian markets. And I want to know why. Because if we have this a dollar crisis on two counts, Asian markets are going to suffer, are they not? Because, I mean, their currencies are going to spike versus the U.S. dollar. Doesn't help them if they're exporting. And certainly, you know, in terms of domestic consumption, I mean, is that going to be positive?
Yeah, well, first of all, you know, when you promoted me, you called me a perma-bear, and that's not really true. I mean, I'm bearish on some things and bullish on others, and I have been bearish on the U.S. economy for some time, and I think that view is correct. But I am quite optimistic on many other economies, especially if we get the big dollar decline. That is not bearish for Asian exporters. As long as the dollar is declining against all currencies, then the rest of the world is enjoying enhanced purchasing power, a higher standard of living. And I don't think any one particular country is going to be at a competitive disadvantage if the dollar is falling against all currencies. But what it will advantage is the consumers in those countries that are going to experience an increase in their standard of living as their cost of living goes down to reflect the higher purchasing power of their savings and their wages. So I am very optimistic on certain parts of the world, and I am invested heavily in stocks in certain parts of the world. And as you mentioned, the emerging markets are doing very well this year. I mean, the returns we're getting in emerging markets year to date are more than twice the returns delivered by the S&P 500. Look, even physical gold year to date is beating the S&P 500. Gold stocks, which have not been doing nearly as well as you would think, given the strength of gold, today they finally came out of their hibernation. But I think today is just the beginning of a much, much bigger move to come in gold stocks. So there's a lot of money to be made if you're investing in the right markets and in the right sectors.
Gotcha. All right. Talk to you again soon, Peter. Thank you for today. Peter Schiff there, Euro Pacific Capital, on the road somewhere in Toronto there. All right, take a look at our Wednesday mystery.